Welcome to today's explainer. So picture this, you're sitting on some savings right now. Let's say you're 30 years old and you've got 10 lakh rupees parked nice and safe in a fixed deposit. Everyone's probably patting you on the back, right? Telling you you're on the exact right track. But have you actually projected that math forward to when you're 45? Today, as you'll see unfolding in our whiteboard explainer here, we're going to sketch out the brutal reality of what we think of as safe money. Because honestly, parking your hard-earned cash in that standard FD might just be the biggest wealth trap of our generation.
Okay, let's dive into this. Every day, you stare at that 10 lakh rupees in your bank account, and you think, man, this really should be growing. You ask around, and the standard advice from your dad or your coworker is always exactly the same. Put it in an FT. It's safe, it's guaranteed. Fast forward 5 years, your 10 lakh becomes 14 lakh, and you feel like an absolute winner. But looking closely at the math challenges that illusion of safety real quick. Because that guaranteed 7% return, it might not be buying your dream retirement at all. It might just be buying you a front row seat to a financial crisis you simply cannot afford.
The math actually reveals exactly why playing it safe is slowly, quietly making you poorer. Watch this. Let's assume you're getting a standard 7% return on a 1 to 2 year FD. Sounds perfectly reasonable, doesn't it? But if you're earning a decent salary, you're likely sitting in the 30% tax bracket. And remember, that FD interest gets taxed as regular income, not capital gains. So instantly, your 7% drops to a 4.9% post-tax return. Now, add in the real world. While the RBI might target 4% inflation, your actual personal inflation, factoring in education costs rising at 8 to 12% and absolutely skyrocketing healthcare, is easily above 5%.
So subtract that 5% personal inflation from your 4.9% post-tax return, and you are left with this stark number right here, negative 0.1%. Yep, this is your real return. You are sacrificing your current consumption for decades, carefully putting money aside, and your purchasing power is just quietly, slowly moving backwards. To put this into perspective, 1 lakh rupees kept in an FD back in 2006 would be worth about 3.9 lakh rupees today. But it costs up to 3.6 lakh rupees today just to buy the exact same things that 1 lakh rupees bought back then. You basically sacrificed for 2 decades just to barely break even. Crazy, right?
And here's the thing, there is a massive opportunity cost happening all around us. India's mutual fund industry is absolutely booming. It crossed a staggering 81 lakh crore in assets by November 2025. It grew 21% in a single year with SIP inflows hitting over 31,000 crore every single month. Yet, despite this wild boom, only 4 to 7% of Indian households are actually invested in mutual funds, compared to like 37% in the US. What does that mean? It means over 90% of Indians are stuck in that FD trap. They're parking their money in instruments that are quietly destroying their purchasing power, all while a massive wealth creation cycle happens right next door without them.
So what is the actual solution here? Let's starkly contrast the two mathematical paths to turning your 10 lakh rupee into 1 crore, a literal 10 times multiplication. And look, it doesn't require a miracle. It just requires time and a decent rate of return. On the FD path, at a 7% return, your money takes about 10.3 years to double. To reach that 1 crore milestone, you'd need roughly 33 years. If you are 30 today, you'll hit that goal at 63, right at retirement. But on the equity path, assuming a historical average of a 12% return in long-term mutual funds, your money doubles in just 6 years. You reach 1 crore in approximately 20 years instead of 33.
And this brilliantly illustrates the core difference between the two approaches. By simply changing your vehicle, moving from loaning your money to a bank to actually owning a share of growing Indian businesses, you literally save 13 years of your life. You hit your 1 crore rupee target at age 50, right in the prime of your life, rather than at 63. This single powerful shift in how you deploy your capital is the absolute foundation of the blueprint.
But you know what? We can do even better. Let's assemble the true wealth machine right here on the whiteboard. What if, instead of just letting that 10 lakh rupees sit there, you added a monthly systematic investment plan, or SIP, right alongside it? If you combine your 10 lakh rupee lump sum with a 10,000 rupee monthly SIP, which is roughly 333 rupees a day, basically the cost of 2 decent cafe combos, and let it compound at that 12% rate, pure magic happens. In just 15 years, your lump sum grows to about 54.7 lakh, and your modest SIP compounds to 50.4 lakh. Combined, you hit an output of 1.05 crore in just 15 years.
Now let's see how this builds into something even more powerful with a concept most financial content completely ignores, the SIP step up. This is literally just the act of increasing your monthly SIP amount by a fixed percentage, let's say 10%, every single year when you get your salary increment. That's it. It requires absolutely no extra lump sums. You don't need to magically find another 10 lakh rupee. You just redirect a tiny fraction of your future salary bumps away from lifestyle inflation and straight into your wealth machine.
By bumping your SIP by just 10% annually, watch how you compress your timeline drastically. Year 1 is 10,000 rupees a month. By year 5, it's just over 14,600 rupees. By year 10, it's around 23,700 rupees. These aren't painful jumps at all. They scale perfectly naturally with your career growth. But by doing this one simple thing, you shave off another 3 years from your timeline. You reach roughly 90 lakhs, practically touching your crore in exactly 12 years, down from 15. This right here is the ultimate accelerant to wealth creation.
Now, you might be wondering, if the math is this easy to draw out, why doesn't everyone do it, right? Well, it's because of a fundamental mindset flaw. You have to stop thinking about your investment portfolio as just money that you can lose and start thinking about it as a machine whose only job is to collect units.
Now, what's really interesting about this slide is how it all comes down to the psychology of discomfort. That's what ruins so many investors. See, your brain is hardwired with something called loss aversion. Losing literally feels twice as painful as gaining feels good. Now, that kept our ancestors alive in the wild, but it completely destroys portfolios today. Look at the chart. The market drops 15%. Your FT-trained brain starts screaming, "This is risky. Protect what's left." So you panic. You redeem your investments right at the absolute bottom and you lock in your losses. You go back to the sidelines, miss the inevitable recovery, and wonder 15 years later why you aren't wealthy.
We need to completely reframe how we view market crashes. A crash doesn't break your wealth machine, it actively feeds it. When the market drops, the net asset value, or NAV, drops. So what happens? Your fixed 10,000 rupees SIP automatically kicks in and buys more units at a massive discount. It is quite literally a clearance sale. Then, when the market inevitably recovers, those accumulated cheap units multiply your wealth. The smartest investors who built crores in India didn't magically avoid market crashes. No way. They ignored them and simply let the machine keep running.
To make absolutely sure you don't break your own machine, let's map out a quick self-sabotage checklist. Flag 1. Stopping SIPs during crashes. You're halting the machine exactly when units are the cheapest. Flag 2. Chasing fancy, thematic, or sectoral funds early on instead of just sticking to simple index or flexi-cap funds. Flag 3. Trying to time the market. Did you know missing just the 10 best trading days over 20 years cuts your returns almost in half? Insane. Flag 4, ignoring the emergency fund, which then forces you to sell during cash flow crises. And Flag 5, chasing a headline number of 1 crore rupees instead of focusing on building passive income that actually covers your lifestyle freedom.
So let's take all this theory and ground it into immediate non-negotiable reality. We've distilled this entire strategy down to a strict 5-step rulebook. Think of this as your installation manual to get the compounding engine running properly from day 1. Let's walk through exactly how to set this up right now on the whiteboard. So, the crucial point is following these steps in exact order. Step 1. The buffer. You need to build 4 to 6 months of living expenses in a liquid fund. This is non-negotiable, guys, so a random car repair doesn't break your equity machine. Step 2. Deploy your 10 lakhs systematically via an STP over 10 to 12 months to get the benefit of cost averaging. Step 3. Start that 5K to 10K monthly SIP and make auto-debit mandatory. Set it and forget it. Step 4. Calendar an automatic 10% SIP step-up every single January. And finally, Step 5. Delete the investment app from your home screen. Seriously, review it maximum once a quarter, because checking it more equals more emotional decisions, which always equals worse returns.
As we wrap up this whiteboard explainer, the projections ahead are frankly staggering. India's mutual fund industry is heading toward a projected 2,791 lakh crore by 2047. That is mind-blowing. The equity culture in this country, fueled by a GDP growing at 7.4%, is just beginning. And you have the opportunity to be on the right side of one of the greatest wealth creation cycles in human history. The math of 15 to 20 years, a 12% return, and a disciplined step-up SIP is proven. It's easy. But having the conviction to stick with it through the scary headlines, that is the hard part.
The only thing standing between you and that 1 crore rupee isn't luck, or insider connections, or even a massive salary.
It is simply starting. You now know the math they never sketched out for you on a whiteboard in school. The blueprint is crystal clear, and the compounding machine is waiting right there in your pocket. So the only question left is, will you stop staring at your savings, escape the illusion of the safe FD, and actually start your engine today? Thanks for joining me for this explainer, and I'll see you in the next one.